welcome back to Building a More Profitable Business series. This is number 4 in our series of 5. Today we're going to talk about budgeting. Again, I'm Jeremy Lott with Foundation Accounting and Consulting, and this is presented by myself and by the Salt Lake HBA. Probably tired of hearing my story by now if you've been listening to all the other installments of our series here. But just want to recap one more time. I was had a landscape company, and didn't really understand my financials and what was going on. I was really frustrated by it because nobody really seemed like they could explain things to me. And I eventually ended up in bankruptcy. And so I went into my accountant to get my taxes done shortly after my bankruptcy, and he told me he'd seen my bankruptcy coming for a long time. And that was just so frustrating to me because here he was, my trusted advisor. I was expecting him to be able to help me out when it came to finances and understanding things, but he didn't. And so I decided right then that my new calling in life was to be a trusted advisor for the construction industry. So I changed some things around, went back to school, and ended up where I am now, helping out construction companies with their finances, with accounting, with their cash flow. Just want to review really quickly time management. We've got the 8 total D's. The first 4 are for dividing up your time. The second 4 are for getting things done. For dividing up your time, you want to spend about 80% of your time doing, 2% of your time deciding, 8% delegating, and about 10% of your time you want to spend designing. Again, you want to be able to spend your time in those last 2 categories, the delegating and designing, because that's how you're going to mature as a company and be able to build something that you can step away from and have it still make you money and still be effective. The 4 D's of getting things done include, first of all, emptying your brain on paper. Get all the things that you need to do out of your head and written down on paper so that your brain isn't using all of its capacity for storage. Instead, your brain can be used for being creative and for problem solving. Once you've done that, you want to go down your list and you want to mark all of the different items on your list as one of these 4 D's, either doing, delegating, deferring, or dropping. So for the doing, these are things that you have to physically do, and they're things that will take 3 minutes or less. You go down through your list, you mark all the things that will take 3 minutes or less, and you go do them right now so you get them crossed off your list. Next thing is delegating. You want to figure out which things you can pass off to either people that you work with or other professionals that can take care of things for you. Then you're going to defer things. That means taking and planning out your projects. Some of the things that take longer, you're going to go into your calendar, you're going to schedule when to do those things. And then the last one is dropping. You're going to figure out which of those items in your head are maybes or someday type items, and you're going to write them down so you have detailed notes on everything you've been thinking about it. File it away so that you have it stored somewhere but not in your brain. Then we talked about profit management, cash management. That goes right along with the time management. We have the equation income minus profit equals expenses, where we mix things around a little bit from the traditional profit and loss equation, which is income minus expenses equals profit. Instead, we're going to give that profit a higher importance by doing income minus profit, taking the profit out first, and then spending whatever's left on expenses, rather than whatever's left going to profit. We're going to do the needle in a haystack project, which is going through your financials and finding things that you can cut so that you can reduce and move that money instead toward the profit account. We're going to set up bank accounts, an income account, an operating expense account, a profit account, and a payroll account. We're going to do all of these so that you can then later transfer, which is the next thing. On the 5th and 20th of every month, you're going to make transfers into those accounts and then use those accounts for their designated purposes. You got to be very disciplined to do this. If you're not disciplined, then you won't be able to keep on top of all this. So, last thing you want to do is celebrate. Each quarter you want to take some of the profit, you want to go celebrate. You want to go do something fancy. Doesn't have to be big, just something small so it's a celebration. And then you want to have larger goals that you can save for over time that you can then go and be able to do. We talked about cost analysis. Go back through this. Just really quickly, we talked about putting things on a truck. We talked about allocating things. We talked about the contribution margin and how the contribution margin can be used then to calculate a break even and figure out how much money you need to bring into the company in order to break even and how many projects that is. And those are the big things from the cost analysis. It was a lot of math, and hopefully everybody was able to follow well. But today we're going to talk about budgeting. There's much less math with the budgeting. But we are going to use the cost analysis as part of the budgeting process. Because, well, here's a quick comic strip. We're on a shoestring budget, so I'd like us all to wear loafers instead. So here's the steps for putting together a good budget. Now, when I say budget, people immediately go to the envelope idea, right? This is all I have that I can spend for this amount. And that is a personal type of budget. Now for a business, your budget's going to be a little bit different. Instead, what you're trying to do is you're trying to plan out your expenses and get a good idea of how much will be able to be spent in the different categories, as opposed to making it a hard and fast number that you cannot go above this number, right? So in this process, we're going to start off with the profit and plowback planning. And that is going to tie directly into the variables that we used from the cost analysis in the previous session. Then we're going to look at balance sheet items and marketing. Then we're going to look at our revenue, which we get from our break even, which again comes from the cost analysis that we just did. And then production, we're looking at doing a budget for direct labor, direct materials, and for overhead, figuring out those numbers. Then we're going to do a fixed selling, general, and admin expenses that we've already calculated a little bit. And then other SG&A expenses. And then last, we're going to put together a projected profit and loss so that we have an idea of where we'll be at a year from now with our budget. Okay, starting with profit and plowback. Plowback means taking some of the money that you've made and plowing it back into your company, putting it back into your company, reinvesting in your company. Okay, that's what plowback means. So how will you grow and improve your business next year? And how much will you pay yourself? Those are the two big questions, and we start with that because as with the variables that we looked at earlier, they're very crucial in calculating the overall revenue that we're going to need. And so we start with the profit and the plowback, or the reinvesting back into the company. So we're going to make a list of equipment or other items that would help you grow. Then we're going to select the most realistic items from the list and find out the cost to purchase outright and the monthly payment if financed. So that's what we're going to calculate first. Figure out those payments on the items that we can realistically plan on budgeting for. And then we're going to determine what you would realistically like to make as a bonus for the next year. Again, we talked about this a little bit in the cost analysis, but it's okay to start small, you know, 20,000, 10,000, 5,000, whatever, or you can go big, but you want to make it reachable. You don't want to end up getting just completely discouraged because you are unable to reach those goals. Okay, then you want to add together the purchase price or the monthly payment and the bonus. You want to add those amounts together, and we're going to plug those then into the break even. Okay? So that's the very first step in budgeting, figuring out the profit and plowback. All right, then we have some balance sheet items, and we talked about this a little bit earlier as well when we were talking about financial statements. Some of the balance sheet items that we need to keep track of are credit card payments. If you have outstanding amounts on credit cards, how much are those payments? We got a budget for that because that's cash that needs to go in the budget. And loan payments, etc. So you want to know how much you're paying on those different things and then be able to project that for a year. Okay? As part of the budget. So go down your balance sheet for the previous year and make a list of all credit cards, loans, and lines of credit. You want to figure all those items out. Then you're going to list the amounts to be paid for each monthly payment, which we've kind of talked about a little bit already. Then you're going to add up the total, and this will be used in the break-even analysis. All right? All right, marketing. Let's talk about marketing. I know that a lot of construction companies don't do marketing. They rely on word of mouth. But it is important to spend some money in marketing because that way you can always keep the pipeline full. And professional companies, companies that are making good money, they all market. And marketing can be as simple as getting hats made, getting uniforms for your workers, getting signs or sponsoring things at different events. These are all marketing things that can be included as part of your budget. Okay, so it is important to market, and in another session perhaps we could cover some of the basics of marketing. So we want to create a plan that includes how you plan to market, how you plan to improve your website, how you plan to advertise, etc. The most common place to market for most construction companies right now is on Instagram because it's very visual. You can put your pictures up there and people can see your great work. Okay? So you want to figure out all the different things that you want to be able to do with your marketing and then plan out how much it's going to cost. Okay? Then you come up with the total based on the plan that you've put together. right? So this total will be used in your break-even analysis and as a fixed SG&A item later. Okay, so it's going to be part of your fixed SG&A, selling, general, and admin costs, which are different from your overhead and your direct costs. Next thing we're going to do is we're going to calculate your revenue. We're going to use the break even to do that. Again, here's the cost analysis we just did. On the far right side is the break even. And that's how we're going to calculate our total revenue that we need. Now, production budget. Production budget is going to include three different things: direct labor, direct materials, and overhead. So the first thing we want to do is determine the size of an average job and divide the revenue from our break-even by the average job to determine the number of jobs needed for the revenue goal. Then we're going to calculate the direct labor for an average job and multiply it by total jobs needed. Okay. So direct labor is a percentage of the total. So if we know how many jobs we have, we know the size of an average job is 25,000, whatever. Then we can figure out how much of that job is going to be labor of an average job, and then multiply it by the number of jobs that we're going to be doing. And we're going to do the same thing with direct materials. We're going to calculate that all out, and then we'll have the numbers all together of the direct materials that we need. Okay? Again, we're doing this based on an average job size. Then we're going to calculate the overhead for an average job and multiply it by total jobs needed. So it's very useful at this point if you have spent the time to do a cost analysis and you have those overhead allocation rates. That way you can help to figure out how much you're going to be spending in overhead on an average job. Fixed selling, general, and admin expenses. We talked a little bit about this before. These ones are usually fairly easy to figure out because we can go down through our fixed selling, general, and admin, and we can determine how much we're going to spend on each of those different projects or on each of those different line items. Like, for instance, rent. We can calculate how much we're going to spend in rent over a 12-month period. We can do the same thing with internet. We can do the same thing with utilities. We can do the same thing with our office staff. Okay? So make a list of all fixed expenses, things with the same payment amount and due date each month, like rent. Then we're going to list the monthly payment amount for each and the account associated with each payment. Okay. These totals will be used in the budget directly. So we're going to have just a direct item for each one of these. So we'll have a line in the budget for rent, we'll have a line in the budget for utilities, we'll have a line in the budget for internet, all of these kind of things. Then we want to go through and we want to see what other expenses we had on the previous profit and loss for the previous year, because we're then going to then calculate those based on an average. All right, so if we had office supplies is a common one that we had for our business, then we're going to add up the total and divide it by 12, and that'll give us a monthly amount. Okay. So we scan down the P&L looking for all other accounts not addressed yet, like utilities, office expenses, professional fees, things like that, if they change and they're not consistent. We're going to make note of each account not addressed and the amount for each account. And then we're going to divide the total for each account by 12 to determine the average amount for that account each month. We just kind of talked about that. And these will be used directly in your budget, as we mentioned. Okay, then we're going to take and we're going to assemble all those different parts together to put them together in one. All right? So we're going to assemble your budget by putting together a profit and loss by month. Okay? We're going to figure out what our profit and loss is each month in our projection. We're going to divide revenue by 12 to determine the monthly amount, and then adjust up or down considering the seasonality of the work. So if you only work 9 months out of the year, then divide it by 9 and spread it out evenly. If you usually work 3 months at the start of the year and 2 months at the end of the year, but it's a little bit slower, then lower those amounts and bump up the other amounts a little bit. Okay? And then do the same with the relative production costs as cost of goods sold. So we're going to add up the total amounts for cost of goods sold. We're going to divide it by 12. And then you can either spread it evenly across all 12 months, or we can do like we were just saying. We could divide it by 9 instead and spread it across 9 months. Or you can have it up a little bit higher in some of the summer months and spring months and early fall months, and a little bit lower during the winter. Okay? Whatever works best for your industry. Next, we're going to add in the fixed selling, general, and admin expenses and the monthly amounts for each month. We're going to budget those individually. Remember, one line for each of those items. We're going to add in other SG&A expenses, as we were discussing. And the P&L by month is now your new budget. So go ahead and enter it into QuickBooks or your other accounting software so you can track budget to actual over the next year. So quick review, we're going to start with doing profit and plowback planning, and then balance sheet items, and then marketing. That's going to be a line item on your fixed selling, general, and admin expenses. Then we're going to figure out our revenue by doing our break even, like we did with the cost analysis. Then we're going to figure out our production budget, which includes a budget for direct labor, for direct materials, and for overhead. And then we're going to do a fixed selling, general, and admin expenses, figure those out. And then other selling, general, and admin expenses, the things that we haven't covered yet from the previous year's profit and loss. And then last, we're going to do the P&L projections. Welcome to the second part of session 4. We're going to talk a little bit now about cash flow and how to maximize it. So according to U.S. Bank, 82% of small businesses fail due to a lack of capital and cash flow. One of the biggest problems they face. 82%, that's a lot. That's 4 out of every 5 businesses fail because they don't have cash flow. I know that's why I failed with my landscape company. Here's some more cash flow statistics. Most small businesses only have enough cash flow to cover 27 days of expenses. That's it. It's not even a full month. The top 25% of businesses only have 2 months of reserves. That's just the top 25%, and they only have 2 months of reserves. The average small business has $374 in average daily cash outflow and $381 average daily cash inflows. So an average of $7 of cash inflow every day. So cash flow is a big problem. So let's talk about why. Why is it you think that businesses have so many problems with cash flow? So one of the biggest problems is that net profit does not equal net cash. And that's because things happen on the balance sheet that happen on, or that things happen with cash on the balance sheet that can't be accounted for on the profit and loss. So you have your profit and loss statement. You have your income, you subtract your expenses, and you have your profit, right? And we expect that profit to equal our bank account. But the problem is we've made some sales on account. So we have accounts receivable, which means that people have promised us to pay, but they haven't given us any cash. Well, also, we've made promises to pay on accounts payable. They get recorded as expenses as soon as we make the purchases, but it doesn't hit the cash until we pay off that bill. And so there's some different variances there that make it so that the profit does not equal the cash flow. Second is a cash basis. A lot of people are reporting on a cash basis. That means that you're using all your resources. So when we operate on a cash basis, we have it in our minds that debt is bad and debt will hurt us. Where actually debt, if we go way back to the first session that we talked in, we looked at liability and how it's similar to the features of a vehicle, and the features of a vehicle make the ride more comfortable. Well, if we're operating on a cash basis, we don't have any liabilities, which means we have no features, which means you're driving that hot car through the desert on a hot day without any air conditioning. So it makes it very, very difficult. Third is a fear of debt. We talked about that a second ago, and that is one of the chief reasons that people choose to operate only on a cash basis. But I added a question right there. Is it better to pay off your house or invest? This is a question we'll get more into here. But which is better? Is it better to be debt-free, or is it better to have investments? The last reason is people are unable to acquire funding. If you can't get funding for a business, then you aren't looking in the right places. even if you have bad credit, there are resources out there. There are places that you can turn to be able to find help. And you just need to find the right person to help you out with that. Okay? Especially with most construction companies, because most construction companies have assets. They have a lot of equipment and things, tangible things that they can put up for collateral. Okay? So let's talk about balance sheet problems. What do you pay cash for each month? If you think about that. Some of the things that you pay cash for go on your profit and loss. Other things do not. Your rent, your utilities, materials, labor, those things all definitely go on the profit and loss. But what about a vehicle loan or an equipment loan? That's on the balance sheet. That's not going to show up on the profit and loss. What about credit cards? Those things all go on the balance sheet. You're going to pay that off every month and use up some of that cash, but it doesn't show up on the profit and loss. What about a phone? The phone shows up on profit and loss. Many of your cash payments each month are on the balance sheet, which is why your cash in the bank does not equal your net profit. Okay? When you pay your credit card bill of $1,000, that is not a $1,000 expense. That's $1,000 cash that you've paid out that doesn't show up on the profit and loss at all. When you go into Mountain States and you pay off your bill, that does not show up at all on your expenses. It won't be on the profit and loss. Okay. The best answer for this is timely and accurate bookkeeping. Timely data entry and reconciliation means you can trust your bank account balance in QuickBooks. If you don't stay up to date and if you don't accurately enter things into QuickBooks, you cannot trust your numbers in QuickBooks. But if you are, then you can trust your numbers in QuickBooks. You can look up at any point in time and you can see how much cash you actually have in your bank account. You can look up and you can see what all payments you have coming up due, and then you can plan your cash accordingly and how to spend it. So always pull an accounts payable report before paying bills, and only pay for materials when you're paid for the job. This is a difficult concept for a lot of contractors, because we are honest people and we don't want to owe people money. We want them to be able to get their pay as soon as possible. But the problem is we're paying them out of our own pockets a lot of the time. And we can't afford to do that. We've got to be able to collect first from our customer and then go in and pay for the items that you've put on account. Okay? Pull a weekly accounts receivable report to see who you need to contact about paying. If you don't stay on top of your accounts receivable, it will kill your cash flow. Absolutely kill your cash flow. Limit viewing of reports to once a week and only pay bills twice a month. You don't need to sit on reports every day. You got to get to where you can trust your numbers so you can pull them up once a week, you can make your business decisions, and then you can move on with your business. You don't need to spend hours and hours and hours looking at reports in your accounting. Okay? And then paying bills twice a month. You schedule when you want to pay people. Don't just pay them based on who's calling on the phone. So here's a good question. If I came out to you right now, could you loan me $50,000 cash? Do you have those kind of resources available to you? Because that's basically what you're doing every time you take on a new customer. You're giving a loan basically to that customer. Okay, we're going to look at the cash cycle in a while here. But every customer that you bring on, you're giving a loan to. Because you're financing their job and you're still making payments on things throughout the course of doing their job, but they haven't paid you yet. Okay? So unless you are cash rich, you have to have a resource to be able to pull from, like a line of credit, like a loan, something like that, that helps you to have cash in the bank to be able to function. All right. So let's go through this a little bit. This is the cash flow cycle. This is what's happening with your cash. This is why you're always struggling to have money in the bank. All right? So your job's awarded. And there at the end is where you receive your final payment. Okay? So right up front, you receive a down payment for a portion. So that's good. I now have as much cash as the blue. Then I'm going to make some purchases on account. Right? Doesn't cost me any cash. They're just sitting on my account. Then I start doing the work on the job. Before too long, payroll's due. I have to pay payroll. So we're going to subtract that amount of payroll from the down payment we received. Then we have some overhead that's due. Got to pay our cell phone bill. Got to pay our insurance. Okay, we're going to subtract that from the down payment received. Before too long, we have to pay our account, all the things that we put on account originally up front, right? And now all of a sudden we're in the red. We're negative because we've used up all that down payment and then some. Then we finish the job and we receive that final payment, and the actual cash that we have from that job at the end is very, very small. You can see that little blue rectangle at the very end of the chart there. Okay, so we don't have much left. Cash flow projection is the answer. All right? That's how we fix this problem. So here's a cash flow projection and what it looks like. Down the left side, we have listed all of the different expenses that we pay. Then we have the vendor, then the amount that we pay and the frequency, how often it's paid, and then the date that it's paid. Up along the top, we have the weeks throughout the year. You do 52 weeks out. Then we're going to take and we're going to plug into our matrix here those payments by week. Now we know how much cash we have to have each month in order to be able to, or each week, in order to make ends meet. Okay? So you can see the highlighted row up there, changing cash. Sometimes it's negative, sometimes it's positive. Cash is going to go up and down based on when we're receiving money and based on when we have money to pay out. All right? So that's what a cash flow projection looks like. And that helps us to know when we're going to need cash, when we have to hit collections really hard, and so on and so forth. Okay? Dave Ramsey's killing your business. Look, nothing against Dave Ramsey. He's a great guy. He has great tools. I am a certified Dave Ramsey education provider. But you cannot run a business with accounts receivable on straight cash. You can't do it. It's not possible. It is possible, but you have to have a ton of cash set aside up front to be able to make those loans to people at the start of every job. If you do that, then you're fine. Okay? Yeah. So, back to the question, is it better to pay off debt or to invest? A mindset shift is the answer to this question. Robert Kiyosaki says, good debt is a powerful tool, but bad debt can kill you. This is the rich dad, poor dad guy. The difference is, good debt is when you're financing a project for somebody else. You're going to get paid on it, right? Bad debt is when you go buy a new truck you don't need. That's bad debt, and you put it on a loan. So you want to use your money based on a cash flow point of view, not on a debt point of view. Okay? Go back here. So back to the question, is it better to invest or to pay off your debts? I personally believe that it's best to do a combination, but leaning more toward the investing into or picking up different investments. You want to create as many engines as possible to create you money. And they've done several studies now, and the math is actually fairly simple to figure out if you have a 30-year loan on your home and you make extra payments off it or on it to pay it off in, say, 10 years as opposed to 30 years. If you were to take that money that you put extra into paying down your loan and instead invested it even in just the stock market in a mutual fund that was fairly, like an 8 to 10% return, you would end up making more money over that 10-year period than you would save by paying off your home early and saving those 20 years of extra payments. Okay? So, better to invest. Okay, back to the question, I can't get funding. The answer is to talk to your accountant. Your accountant should know people that can help you out, especially as a construction company. Should be able to help you to be able to get funding that you need for your business. A line of credit is a huge thing that I use with all of my customers, because a line of credit is something that you can make a draw on, then you make interest-only payments on it, and then when you get paid, you can pay it back. And that helps you be able to make it through that cash flow cycle that we looked at earlier, so that you always have cash in the bank rather than slowly dipping down to where it's negative and then having to juggle money to make payments. And then finally you get paid and it brings you back out of the red. Okay? If you have a line of credit, you can make a draw on it, responsible draw on it at the beginning of a project, can float you through, and then at the end of the project, you pay that off. That way you always keep cash in the bank. Okay? If your accountant can't help, find someone that can. I certainly can help you. If you have any additional questions, either on budgeting or on cash flow, feel free to reach out to me. I'm more than happy to help you out, answer any questions that you have, and help direct you in the right direction. Again, my phone number is 801-440-4540. You can call or text 801-440-4540. Or you can reach me by email at jeremy@foundationacs.com. Again, that's jeremy@foundationacs, which stands for Accounting and Consulting Services.com. And my website is foundationacs.com. So let me know. I can certainly help you out. And thank you very much for participating in this series. And hopefully we'll get more together to bring out to you soon.